Welcome to another edition of Risk and Return. I'm Charlie Gasparino with my partner Bob Sloan of S3 Data. We got a really smart guy coming up. I don't know. It's a toss up between Bob and Jim Chanos.
No, Chanos wins.
Bob, I love you too. So let's just say it's a toss up, but we'll get to Jim later in the program. Right now, let's get to some of your market calls, your actionable items, because we have an audience that has limited time and wants to make a.
Last week we made a call on keys, a bullish call on keys. Now remember, these are incredibly short-term, one-day calls. They're based off a price action of a stock, how it reacts going into an earnings release, and then how it correlates to short interest. And there's a relationship between the price action of a stock and the short interest. And so last week we said keys was in our model was signaling a bullish call, and it was up 5% after earnings. And so we got that one right. We also talked about Target, which we released I think on Wednesday or Tuesday before the earnings on Wednesday.
Oh boy, that was a shit show. Excuse me.
Right, we were very bearish. You can see a lot of times the price action as it relates to short interest was a bearish signal. The stock was off 7%. It continues to be off. We also were slightly bullish on Walmart. The stock's flat, so neutral. But our picks are running about 60%. And remember that, short term can mean a lot of different things to a lot of different people. We're not an investment advisor. We do not tell you what to buy or where to buy it or when to buy it. We're just saying on this particular day, however you want to express this particular bet in the marketplace, our data is telling us these are the signals that are either bullish or bearish, and we'll leave it up to the viewer and listener to figure out how they want to express those bets.
And let's be clear here. When you're batting 300, that's pretty good. You're batting 600.
Yeah, so far. I mean, everybody goes through good streaks and bad streaks, so we'll be no different. But interestingly, Charlie, we're batting 60% on the short side and 60% on the long side.
That's interesting. Why don't you go through some of those?
Well, that's what I was saying is that the green is mostly on the long side. If you look at keys, we were long that, we were long AIG, and then a couple other stocks as well. So, the shorts, Target, certainly Palantir, that was one of our better calls, and Robinhood.
Walmart's an interesting play because I've been doing a lot of reporting, and we'll get into that later about retail. Is that Walmart is a company that, just from a fundamental standpoint, can take some of the hits from tariffs. I remember Trump has gone after the CEO of Walmart saying, eat the tariffs, because he warned that he might have to raise prices. And this is a very thin margin business. This is they make money on bulk, on scale. So they have to, and they import a lot of stuff or a significant amount of stuff from China. But it can spread. Walmart can spread out its the tariff increases among a lot of products, so it could buffer the price increase. Maybe your data is saying something about this. This might be a good retail play once the tariffs kick in and hurt retail companies.
Well, we got to wait for the next earnings release, right? Remember, it's a one-day signal, so we're not telling you what to do after that one-day signal they announced. We have to wait for the next time. Next week, we don't have any new picks this week because next week's such a heavy earnings week. It's Memorial Day coming up. You have NVIDIA coming up. You have Salesforce, et cetera. It's a big earnings day on Wednesday, so we'll drop more predictions on Tuesday as we come into those earnings dates. But one thing I think that we should talk about a little bit is the bond market.
Oh yeah,
the bond market really woke up this week, and it woke up in a very interesting place, which is Japan. If you look at the super longs 40-year bond in Japan, I mean, the yield is up to 3.5%. People have to remember, after 35 years of deflation, JGBs were at zero, sometimes negative rates. So this is a really interesting thing. You have the BOJ as one of the biggest buyers of treasuries in the world, maybe the biggest. And, all of a sudden, there's a lot of choice. And I think these tariff conversations with Walmart, with such a big giant like Home Depot, et cetera, people waking up like, hey, you can't stuff the companies. It comes out in some form, and that's inflation.
And you can't stuff the countries. I mean, here's something interesting. And, this gets back to my reporting right after Liberation Day. I remember being at our favorite restaurant, Ilio's in Manhattan. I'm sitting at the bar with my iPhone, and it's starting to light up. And all these people are telling me, these are bond traders, saying, what is going on? Like yields on the 10-year and the 30-year within hours started to shoot through the roof. There was something obviously wrong with the mechanics of the bond market. Something was going on. Short-term borrowing rates were freaking out. I mean, the whole thing, you name it. Some of that was a reaction. A lot of that was a reaction to the tariffs, but there clearly was foreign buyers dumping U.S. treasuries. A lot of people thought it was Japan back then, not China, but Japan.
Right. So, one of the more interesting things we talked about one of our earlier shows was the short covering going on in some of the countries where treaties were being negotiated first, like Japan, et cetera. So we've been keeping an eye on that. We'll refresh that next week. European short interest and exporters still remains very high, and we'll see, what our data says about the line of negotiating and negotiators and the time of those negotiations and when they'll come to fruition.
Yeah, we should point out there
has been a very good predictor of who's actually negotiating and who's not.
Absolutely. We should point out that the talks with Japan are now just starting to heat up. My sources are telling me there's a lot of saber rattling on both sides. Some of the sort of sticking points involved how much the Japanese will pay for U.S. military involvement in Asia. We do in many ways protect them from China. So, and we do have bases in Japan, as you know, famously. But there's talk about like how much more money they shoulder. Trump wants them to shoulder more. If you notice, there hasn't been any deals. There's no China. Even the UK deal wasn't really a deal. It was a weird sort of very superficial framework. There's been no India deal, which people thought was coming. I reported it, moved the market on it, and then it stopped. And one reason why that stopped was because of the war, the tensions with Pakistan. It was kind of a almost war. It was, they were lobbing some missiles at each other and then they stopped, but who knows? So they're kind of distracted. And you have Japan. This is kind of interesting. The market is lulled into believing, Bob, that, Scott Bessent, the Treasury Secretary, is going to put the genie back in the bottle here on trade. He really hasn't done it yet. So
there was a pretty interesting chart that Goldman put out about the gross positioning of hedge funds, meaning risk on positioning of hedge funds being at an all-time high. And
really interesting.
Yeah, that came out yesterday. I think you have to adjust those things for how much capital was in the hedge fund industry, let's say 5 years ago versus today. Obviously a lot more today than say 5 years ago. But still, risk is on right now. We see it. We see the uptick in activity, and we see it in the uptake of hedging activity. So risk is on.
So the alleged smart money is saying the market is setting up for a correction.
No, they're just saying risk is on, meaning they believe that some of these things will have a better outcome than maybe.
Oh, okay. Okay, gotcha.
Then the newspaper headlines are saying that they believe that these things will be solved, and that risk is.
Also, go out and take risk. You're dealing with the stupid reporter here, Bob. I'm sorry. For our many trading, viewers who are going to say, "Who the hell? Where did they get this Gasparino guy from?" But in any event, Bob, any more calls you want to talk about? We do have a short week next week, right?
We do, and the one I would love to talk about is Supermicrocomputer, SMCI. Now, this is our chart. This is our product that we put on the Bloomberg terminal. It's our app, and what it does is.
And we should point out that S3 is the most popular third-party provider of data on the Bloomberg terminal.
We are, and we've sold the most individual seats, apps of anybody that's in the App Store on the Bloomberg terminal. And what the app does is it it's a search engine on top of our database. So you can slice and dice the data and take a look at 60,000 securities and really understand any index in the world, any sector, what's happening with both short interest, but also on the long side as well. And next week, we have working on a really, really interesting piece on battleground stocks. So where the tradable float is equal to the short interest, meaning the amount of money short is the same as the amount of money that can be traded long. And there's a lot of really interesting stocks out there where if more capital comes in on one side, the long is going to win. But if the capital comes on the short side, the shorts are going to win. We'll have a lot to talk about next week. We have a special guest in Jim, and we didn't want to crowd it out with too much information this week because Jim has so much to say. But one of the things here is the short squeeze. And if you look at the orange line, now this stock has 100% volatility. It's incredibly volatile. And you say, well, what's that orange line going up and down? Well, the stock has 100% volatility. It's moving. But the one thing that you can see very clearly, the green line is the stock price. The orange line is our squeeze risk score. And you can see on many occasions, it's particularly, let's say in January, in April, and now, when the stock moves, the orange line moves first. It anticipates the move in the stock price. And so this is an incredibly squeezable stock. Shorts are losing a significant amount of money, and it's up like 40%, and it probably goes higher.
Now, Jim is going to come on in a few minutes. I'm not going to put words in his mouth and talk about how short selling is still been a pretty good business if you think about it. So just that's the counter argument, which we give you both sides and let you decide what to do with your money. Thank you, Bob. That was interesting. Let's get to some of my headlines. I don't know how much money you can make off of this, but everybody wants to know what the hell's going on with Sherry Redstone. Donald Trump, you remember Trump sued CBS, which is owned by Sherry Redstone's Paramount, for $20 billion, right? He says that CBS, a subsidiary of Paramount, screwed with an interview with Kamala Harris, which took out her word salad. They were playing fast and loose. It materially damaged him. Obviously, it didn't because he won the election, but in any event, he sued. And what's going on is very interesting. Sherry wants to sell Paramount to an independent studio, Skydance. It needs Trump's approval, his FCC's approval, while he has this lawsuit, which he did not withdraw. A lot of people are saying, tell Trump to pound sand. And it's Sherry's, from what I understand, Sherry Redstone is poised just to settle it, maybe throw him something like $50 million and get her deal done. There is let's say a disagreement on the board whether he should do that. Some people saying yes, some people saying no. She is inclined to settle. I've got that almost firsthand. It's been described as, because this is like every day people think this thing's going to be settled, as decision constipation. Just to put it bluntly, that she's like I don't know. I don't want to get too much into the scatological references here, but you get what I mean. Any day now, this could happen. I think she's going to settle, and then the deal gets done, and then Paramount is a part of David Ellison's Skydance. That's the son of Larry Ellison, and CBS becomes part of that, and then they figure out what to do with their media properties, which is going to be I think the irony here is this is all over 60 Minutes and the CBS News subsidiary. The head of the CBS News, Wendy McMahon, resigned this week. From what I understand, this new Skydance management, and it's with a combination of the people at Redbird, a guy named Jeff Shell is going to be running the show. They don't care too much about the news. I think they'd sell it if they can. It's the sports they want. And so the news thing is giving them the agita right now to get the deal done. If she settles, I think the deal does get done because I do think they're related. It's just my opinion, but they shouldn't be, but it is. and you're going to get like a new ownership of CBS, and it's going to be pretty controversial and interesting. The other stuff I'm looking at, I was looking at Japan. We kind of went through that. That to me, listen, I'm an old bond reporter. So most people, their eyes glaze over when you talk about bonds. I believe bonds. That's the plumbing of the U.S. economy. If this whole blending market, it's called the credit market, somehow seizes up, you don't have an economy. That's basically catastrophe time. That's what happened during the financial crisis, by the way. Nobody was lending to anybody. Lending is the key to business. I mean, even if you're a profitable business, you are borrowing short term to pay your employees, to pay your suppliers until the money comes in. That's just how it works. It's kind of scary when you start seeing yields start to hit that 10-year starts to creep up to 5%, the 30-year over 5%. And that's kind of what we have now. Any thoughts on this, Bob? Do you think is this just, a little indigestion, or are we seeing something, more sort of intrinsic to the economy, maybe existential to the economy?
Remember what happened in the UK? Shortest tenured prime minister.
Yeah, Liz Truss.
Bond market threw a fit. The growth policies were thrown out. And, 10-year at 5%, bond market's telling you something.
Remember, the UK pension system is a weird cat. I've been, it's funny who's over there in the UK recently. Jamie Dimon met with the Prime Minister, Keir Starmer. I believe Larry Fink met with him recently as well. Jamie, the head of JP Morgan, the largest bank, Larry, the head of BlackRock, the largest asset manager. And, the UK's, sort of financial system is weird. Those pensions control a lot of stuff, and they also hold a lot of bonds. And, so it's almost apples and oranges in the sense when you compare our investor class with theirs, our bond vigilantes with theirs. Their bond vigilantes, I think, could have much more power over the fiscal situation than ours do. But you shouldn't just gloss over this. This could be, just sort of warning signs. And again, the tariff situation is going to be, I think, key to this. I mean, I think even more than, the Trump tax cuts that people worried about deficits for, it's the tariff stuff, I think, that has bond investors freaked out. But time will tell. And if I'm wrong, I'll eat my hat, even though I don't wear a hat. That's the second thing I'm doing. Also, I'm kind of looking at, what's going on with crypto is fascinating. I mean, there's a bill that's just floundering around. The Senate passed the stablecoin bill. You know what a stablecoin is? That's literally one of the best types of crypto you could have. It's backed by U.S. assets. It could be backed by treasuries. There's a lot of reasons to pass this bill by Senator Hagerty of Tennessee, Bill Hagerty, and it's just getting so much sort of pushback, even as it passes procedural votes, and it looks like it's going to be law. They're going to pass it. There's still a lot of pushback, and I think one of the reasons why there's pushback here, Bob, even like concern among Republicans, is that President Trump's crypto business is an optical problem for this market, and he is the regulator of the market because he appoints the CFTC chief and the SEC chief, the Securities and Exchange Commission, and this Commodity Futures Trading Commission. They both regulate crypto, and I think it just rubs people the wrong way that Donald Trump, as president, is via family members and outside associates, it's so heavily involved in this. Elizabeth Warren used that as a cudgel to sort of get people maybe to try to change their vote. And she almost screwed things up on Monday before the procedural vote. It passed with 66 votes, but, Rand Paul didn't vote for it. There was a guy named, there was a senator from Kansas. It's slipping my mind. He didn't vote for it. So that's two Republicans. And it's just like, I'll say this. If I'm going to look at controversies and scandals, the Hunter Biden thing, what made that so repulsive is that it was all done, you wouldn't have known it was done unless the New York Post, where I work in part, is unless they got the laptop. All right. This is all done in the open. We can debate what Trump is doing. That's the positive. Totally transparent about everything.
Well, we have to get our first guest back on, because Ellie knows more
She
about
does. She
everything.
does.
By the way,
She would agree with this. I think I don't want to put words in her mouth, but
he said this on our show.
This is different. You see, but still, there's this appearance, this optical thing, and I think it's going to rub people the wrong. I'll tell you, it's going to be an issue for crypto legislation going forward. And Elizabeth Warren is clearly on the case on this.
Right, Ellie had it nailed. Excuse me. She had it nailed about the problematic nature of the legislation, and that was 3 weeks ago. If you had listened, you'd been
yes. She
had it totally nailed.
She predicted this sort of the volatile nature of getting this thing passed, and she also has been doing great work up to the minute. She predicted it would pass the procedural votes, and her reporting suggested as much. And she's got Crypto in America, by the way, is her newsletter, and if you're into crypto, that's a must read.
I mean, she's great.
Yeah, she's great. Right, and I take credit for training her. How's that?
Oh, listen, there's a long line of people you've trained, but you trained a particularly good one with her.
I agree. It is with my great pleasure to introduce another guest to our risk and return conversation. It's an old friend of mine, a man of incredible integrity and intelligence. Great guy, knows the markets, knows stocks. Maybe one of the smartest people I know on Wall Street. It's Jim Chanos, the legendary short seller. He's not as nasty as his reputation, as you will soon find out. He's actually a really nice guy. Love sharing steaks with him and martinis. And here we are. Thank you, Jim, for coming.
You couldn't find anybody under 50 years old for this panel?
Bob and I are in that over 50 demographic, so why should we stop now?
Good to see you guys.
Good to see you.
Go ahead, Bob. You take this away. You're the short selling expert, not me.
Sure. Well, we have the dean, the master, the absolute most knowledgeable person on the short side of the market ever. So, Jim, thanks for being here. We have a chart in front of us that is the Goldman Sachs basket of the most shorted names in the Russell 3000. And you've often said that more stocks go to zero than go to the moon. And so we have a 5-year chart here looking at the total return of the most shorted stocks. What do you see, and what does it say about the common perception that shorting stocks right now is just a bad idea?
Yeah, well, the empirical evidence of that is that view, which is widely held, and by the way, thanks for having me, guys, is just incorrect. And in fact, what I keep pointing out to people is that post-GameStop, which is sort of the thing that seared into the brain of every hedge fund manager and retail trader and institutional trader out there, that just the short side was now kryptonite. In fact, it's been exactly the opposite. GameStop represented the top in those types of companies. So what you're looking at here is an index that Goldman Sachs puts together and rebalances, I believe, every month. And it's the 40 or 50 most highly shorted stocks in the U.S. market. I think their data set is the Russell 3000. And so you'll see that it had this monstrous peak at the end of 2020 and into early 2021 when the GameStop, AMC et al. Squeeze occurred. And the quite remarkable thing is that subsequent to that, the S&P has still gone up, but this index is actually down about roughly 50% from its highs. And over the last four plus years, the S&P is up about 70% with dividends reinvested. So the fundamental short side, and I'm just using this as a proxy, has been a pretty good place to hedge your long exposure, which is historically what it's always been, early 2021 notwithstanding. And so I just wanted to send it along because I think your viewers on this podcast will find it interesting. It's not the conventional wisdom about fundamental short selling right now.
The short on AMC was obviously one of the best trades. If you could survive that period, I guess, between January 2021
and May, June of the same year
to the June.
Yeah.
man, you cleaned up. I mean, this is a stock now. It's trading at pennies after a 10-for-1 reverse split. I mean, that says 324. It's really 32 cents.
It's remarkable. And I know you were involved, Charlie, in pointing this out, and we were as well on social media to retail investors. Just please stop and step back and look at what you're doing. And it was all about the shorts couldn't cover and the short volume and this and that. And meanwhile, the company in its filings was telling you that it very much, you might not want to buy the stock they were offering because it might go bankrupt. And the amount of dilution that was coming just to fund their operations and losses, because let's face it, the movie theater business had changed post-pandemic, really was stunning. And it was a remarkable example of cognitive dissonance on behalf of retail investors who were absolutely convinced that it was going to the moon because there were a lot of short sellers in it.
Right. One question I have, Jim, and then I'm going to turn it back to Bob, is do you think the regulators, why would it take us, and you and I took a lot of heat on social media for this. Why did it take us to point this out? Where was the SEC in this?
Yeah, the SEC has been defanged now going on years. And I think that really.
And by the way, let me just, before we get the general counsel of S3 calls, I'm not saying anything was anything illegal here. It was just the notion that a bunch of people on social media can sort of twist a narrative, and there is no, there's no regulator saying, watch out, guys. Seems bizarre.
Well, and also post GameStop, there was a change, because I spoke to congressional staffers when they were getting ready to do the hearings in 2021, post GameStop, what happened. And they tried to paint short sellers as the villains. Right. And I kept pointing out to the SEC and to the staffers, the short sellers were the ones run over in that episode. They weren't the villains. And maybe they overstayed their welcome, and, we're big boys, you take your losses and move on. But trying to paint the short sellers as the villains in that episode was the ultimate irony. But congressmen and congresswomen did hear from their constituents, claiming that the short sellers were preventing them from making untold riches in these very questionable companies.
Where's the investor education? I guess they don't watch. They should watch our Risk and Return, right?
I teach a course about this, and remember, stock price is the most vigorous prosecutor and the best defense attorney you can have. Nobody really cares when stocks are going up. They only really care when they start losing money.
Jim, I have a couple of questions for you. One is the rise of indexing and the index and ETF investing over the last 15 years. It's just so dominant in the long ownership structure. How does that change the opportunity set on the short side? And where do you think it goes from here? So
I know you know this, Bob, because it's your business, but it's a double-edged sword, right? On the one end, the bad news is that there's sort of mindless buying of everything if the flows are there. That's the bad news. The good news is, and one of the things I was most worried about years and years ago, was that you simply wouldn't be able to borrow at any price stocks that were obviously great shorts. And the rise of indexing has actually changed that by making large amounts of equities available to short sellers, albeit at a price that might not have been the case 20 or 30 years ago.
Right. And integral to the selling of the ETF is the stock loan revenue. That's exactly right.
Exactly. And it's also enabled you to do option strategies because the dealers can borrow. So it is a two-edged sword. Is that yes, as long as the flows are there, you're going to be facing generally an upward trend. But on the other hand, it's easier to affect the trade as a professional as it otherwise might have been.
Right. And just let's move on to micro strategies. I have a lot of questions there. One, it would be great if you just explain to the folks on X, which is where we drop this show and our podcast. You're trading for a spread. You've put a trade on to capture a spread. The company is leveraging everything in its capital structure to go buy Bitcoin. And I'm not sure, when I read stuff about what you're doing versus what the company and Saylor, everybody says, well, they're selling stock and, they're buying Bitcoin. And that's just not, it's apples and oranges. And so the question we have is the company, like Long-Term Capital, is just so unbelievably levered on a spread and so dependent on financing that it goes away? Or is it something that the financing stays and keeps them in business, and you just kind of wait the game into the spread mean reverse?
So it's more the latter, Bob. They are not hyper levered because Saylor has done the smart thing. And I want to step back and for all the people that don't understand this trade, particularly all my good friends on social media, I am doing the exact same thing that MicroStrategy is doing. Basically, I am actually selling MicroStrategy stock, which is what they're doing, to buy the underlying asset, Bitcoin. And yes, they have a software business, and we valued it at between 500 million and $1 billion. But the fact of the matter is that this is a Bitcoin holding company, and in effect, right now, you are paying, if you buy MicroStrategy at $400, I think it's where it closed today, you are buying Bitcoin at basically 2x the NAV, meaning you're paying about $220,000 for Bitcoin, which trades at $110,000. And all we're saying is it's in MicroStrategy's interest to keep selling equity and equity-related stocks, to keep buying the underlying, because they do add value that way, and that's fine. But I'm going to do the same thing they're doing, and of course, Wall Street being Wall Street, although there's only a finite amount of Bitcoin, which is what I'm long, there are lots of copycats that have now cropped up to do the same exact strategy, thinking they're going to get rich by buying Bitcoin and having the market value it at 2x or 3x. Right. And of course, I always point out, like the Fed, Wall Street has a printing press. And if an idea gets too popular and too silly, Wall Street's going to create paper to fill the demand. And that's what it's doing right now.
So
we're doing the same thing
question.
Companies doing.
So you're saying that at some point, the investor class on MicroStrategy is going to get, smart to this trade and say, this is just nothing but dilution. And then
they're paying $2 plus for $1, and so the company is doing everything in its power to close that spread too. So there's a catalyst, which is great, and of course MicroStrategy has over a $100 billion valuation, so there's no borrower problems. So this is, I haven't seen an arbitrage like this in this size in years and years and years. And it's really due to retail investors who have convinced themselves that this leverage play on Bitcoin is the way to go. And I keep telling them, just borrow money yourself to buy Bitcoin if you want to be levered. You don't have to pay 2x for it in the marketplace. And that's it. It's nothing more than that. I don't have a view on Bitcoin. I don't know where it's going. I don't know what it's worth. But I do know that it's not worth 2x the last trade. And
right.
so...
Have you spoken to Saylor about your call?
No, no need to. Again, I agree with him. I'm doing what he's doing.
Yeah, and we've noticed the float go up, and they've done a lot of things in the cap stack to go out and buy Bitcoin.
Now, what they are doing, Bob, to your earlier question, however, is they were just basically selling equity via the at the market offerings. Lately, they've shifted to doing perpetual preferreds at relatively high coupons. Yep. So they're, I think they feel that maybe, by issuing all this equity, it's hurting the stock price relative to Bitcoin. On the other hand, they want to buy Bitcoin at a discount, so they're still going to keep doing this. So they're starting to lever up again, but it's still at relatively low amounts relative to the amount of equity they've.
By the way, isn't that what GameStop is doing now?
Yeah, they're doing it too. Yeah,
they're in the trade.
Yep.
It's amazing.
It's amazing.
Go ahead, Bob. I'm sorry.
Yeah, so an open-ended fund trading at a massive discount, then you can put the trade on if you want.
Right.
Yep. Okay. So next question. What do you think the biggest blind spot is for long-only investors today?
I think that one of the things that I'm concerned about, and it has not come to pass. So I've been dead wrong for a better part of 5 to 10 years on this, is just how much corporate profit margins have continued to increase to the detriment of almost everything else. It's been amazing to be in corporate America for the last, since the global financial crisis, and corporate margins, which used to be one of the most mean reverting series in finance, have not mean reverted now for 15 years. And margins just keep kind of creeping higher. And so we're really at the point now where corporate profitability is at all-time highs, and we're putting pretty high multiples on those high margins.
Oh, yeah.
And so far that's been okay. But God forbid if we ever, for whatever reason, if profit margins mean revert, the downside is going to be a lot greater than people think.
Do you think the tariffs could be that catalyst?
They could be. I don't think anybody really knows for sure. I mean, we don't know how much people are willing to swallow, how much demand will drop off, or if it'll be a non-event. It's still too early to tell.
So in that vein, what do you think are the sectors that would be the source of the next great short opportunity? AI, healthcare, private equity.
So one of the things we're doing a lot of work on right now, just to kind of give you a preview, is we made a lot of money in the flip side of great technological disruptions, and the last big one was the internet, right? And we sort of stepped back and said, okay, the internet is going to create great value in the Amazons and Microsofts and what have you. But we looked for two things that happened. Number one, overcapacity in hardware, and that was the telecom guys, the fiber optic guys, the CLECs back then, who just assumed that internet growth was going to grow double every 3 months, which it ultimately didn't, and then built all this capacity and ended up having indigestion or going bankrupt for about 10 years. That was number one. The other, even better place was in businesses that had analog business models that became digital. So think like Blockbuster or Kodak or the Yellow Pages or whatever. Anything where basically you had a physical product that became digital, profit margins collapsed. And those business models went away. And they were great fundamental shorts for better part of 10 years, from
newspapers, unfortunately.
So AI is going to build a lot of business models. It is going to destroy a lot of business models too. And everybody's focused, as always, on the next great companies like NVIDIA and others that will benefit particularly from the build out. But we're looking at companies now that have business models that literally could go away in 5 years or 10 years, because AI is going to basically take away their value-added moat. And
give us some examples.
Well, I don't want to steal my client's thunder too much, but I would say any business that has a lot of embedded bodies that are in effect hand-holding or consulting, that I think are going to be really challenged, because whatever you're doing and charging the client for, they're going to ultimately be able to do themselves. So think of a company like IBM, which is at all-time highs, which people think is a tech company. It's really a marketing and consulting company.
Oh yeah,
it's a body shop.
Absolutely,
100,000 people, and they're basically telling government agencies and kind of businesses behind the curve on how to run their IT department, how to service their mainframes, and that kind of business is going to have a lot of pressure on it. And there are others too that are aren't immediately apparent, that we think are going to, a couple of years from now, people are going to say, oh shit, AI, what were we thinking? This is going to destroy this business. So big technological waves tend to be very good on the short side with a lag.
Jim, when you were studying at Yale and you were a young student, everybody was saying, hey, it's long-term investing. This is how you get in the market, so on and so forth. Now you teach a class at your alma mater. Mm-hmm. What are the best questions that your students ask? And when you look back at yourself and your experience and you're saying, I was one of those folks at one point in time. What's changed? Is everything momentum for them? Are they so skewed to the gamification and the technology and the way they trade that the value things you're trying to teach take a back seat? What are you gaining? What's the feedback you get as an investor teaching some of the smartest students in the world?
Yeah, like anything, we're kind of prisoners of the time frame we live in, right? And when I went on Wall Street, 75% of people on Wall Street from 1968 to 82 lost their jobs. And so when I was interviewing in 79, people thought I was crazy to go to Wall Street. I made more money working in a steel mill for 2 months between my junior and senior year and my sophomore and junior year in Milwaukee, Wisconsin, as a union worker than I did my first full year on Wall Street. And so Wall Street was blown out. And now it's exactly the opposite. The two places everybody wants to work is either in technology or on the street. And things change. I mean, this has been one enormous wave since basically the three of us got into the business. But there could be a change, and I try to teach my students, because we look at the fraud cycle and the financial cycle going back to the 1680s. And I know you're the actual historian on the panel here, Bob, and you know what those waves are like.
Yep.
And I just caution people to say, be flexible, understand, learn the principles of business. It's a little late to teach them ethics because my students are in their late 20s typically, but understand that nothing is forever. And particularly with how fast technology changes today, be prepared to be nimble in your careers, and be willing to maybe take more risks than you otherwise would think you have to take to stay ahead of the curves. Because particularly with AI, I think a lot of knowledge businesses, which is at the end of the day what we're all in, are going to basically be set with landmines that we don't even know about. Yeah.
Well, hopefully the AI computer won't be breaking news anytime soon, but you never know. You mentioned fraud, Jim. You're known as a guy who uncovers fraud, famously Enron, many others. Although your day-to-day work on just looking at stuff that's overvalued and pointing out these sort of market, these sort of market back doors and blind spots, I guess is the best way to put it, is really how you make your money. But do you see any frauds out there? Like, are there any Enrons popping around?
What's so interesting to me, and my students ask this question, is that what I've been saying now for the last handful of years is not only are we in the golden age of fraud, but it's staring you right in the face in many ways that it didn't 25 years ago in the era of Enron. With Enron, you had to do some digging, right, to realize that there was stuff going on off the balance sheet. And a lot of things didn't make sense. Companies today are more and more brazen with how they present their financials. They basically simply will tell you that you should just not count a lot of these costs. And so I think that one of the ways the SEC has really fallen down is by allowing companies to aggressively use pro forma metrics to basically convert losses into profits. If Enron had that regime back then, they would have told you everything because nobody would have cared. And so you see companies with enormous amounts of share-based compensation or restructuring charges or whatever, and simply adding everything back to give you a number that isn't a real number. I remember GE a few years ago in one of their quarterly releases had something like 20 plus pages of adjustments to their earnings. I mean, it's every company almost. It's not just some high-tech companies or startups. It's basically the Fortune 500. Almost everybody now has some sort of adjustments to their profits that either may or may not make sense. And investors have gotten very used to, as I point out, putting multiples on expenses. And that's something you probably shouldn't do. You should put multiples on profits. And adding back large amounts of expenses to get a higher number and then getting a multiple on that really adds a layer of risk in this market that I think a lot of people don't realize.
I mean, that's a good place to end it. Although I think Bob has one more question, and then we'll let you hit the martini party, so to speak, Jim.
Yeah, Jim, if you could short one company, reshort one company, armed with what you know now, which one would it have been? Which one would it be?
Would it be? So we'll talk about the current kind of portfolio. So it's actually one that I added to a couple weeks ago, but not enough in light of what happened today. Given what we saw, probably the most obvious short, where I'm kicking myself where I wasn't bigger, have been the solar panel leasing companies. We've been short them for years. Sunrun,
Sunrun, right?
Yeah, Sunrun was down 40% today because of the tax changes. But the fact of the matter is, this has been an accounting scam for years and years and years. These companies lose hundreds of millions of dollars every quarter. And again, pursuant to our last conversation, they report these pro forma metrics of net present value of the kilowatts put into the thing, discounted back over 30 years and blah, blah, blah. And just meanwhile, the cash is just draining out of them every quarter. And they're enormous users of securitizations on Wall Street and raising all kinds of gimmicky tax equity deals to sell the tax credits. But the fact of the matter is they've been all insolvent for years. And even last week, Sunrun still had an equity value of over $2 billion. And so Sunnova has gone down 99% or 95%. Sunrun's gone down since its highs about 90%.
Wow.
But this was obvious 4, 5, 6 years ago, even before the tax law changes.
All right, Jim, we're going to leave it there. Can we get you back on?
Sure. Just give me enough notice, guys, and keep the martinis cold.
Yeah. Thank you, Jim.
We will do that.
Ladies and gentlemen, the great Jim Chanos. Thanks, Jim, for joining us.
Thanks, guys. See you soon.
Well, that's it for Risk and Return, another eventful week. Bob, I've had Jim Chanos. I've interviewed him for years at CNBC, at Fox Business, my New York Post columns. He always makes news. What do you think the headlines were here? I mean, I could see the MicroStrategy headline, Chanos says he's doing exactly what Michael Saylor is doing.
Yeah, I think he's still a student of the accounting games that go on and the ad backs that are happening on pro forma business results. And he's still at it. He's still in the game, and he broke a little news. And he's just, I think a great balance for everyone to listen to what's on the other side and what do we need to be aware of.
The other news I think he broke, which is fascinating, is the fact that short selling is still a profitable business, despite everything we hear that it's not, that it's you can't short these stocks. I mean, his charts and explanation of that was key.
And his view on AI, which was very interesting.
Oh yeah. I might be looking for a job. I don't know if they can AI you and I. Well, maybe they can. I think they broke the mold when they made us, Bob. Anyway, that's it for us. Risk and Return. I'm Charlie Gasparino with Bob Sloan. See you next week.